What's up guys, welcome back, and in today's video we're going to be talking about tax for gig workers, how to do your tax in Australia. We're going to keep it so simple guys. We're going to break it down into three different areas. You get through these three areas, sweet, you're on track for tax, nice and simple. But first and foremost,
this is Dr. Phil. He is not a financial advisor. This is me. Like Dr. Phil, I am also not a financial advisor. We both do not provide financial advice. This content is for education and entertainment purposes only. I'm just a dude who makes videos. If you need financial advice, seek a licensed professional.
This video is not for people registered for GST, okay? So if you're earning more than $75,000 per year and are registered for GST with your ABN, video not for you. You should already be doing your business activity statements quarterly. So this is for people who are just going to do their tax at the end of the year. So once a year, submitting their tax. There's just three columns we're going to cover today, and then once we've gone through them, you can either go lodge your tax yourself, you can jump onto MyGov, sync up the ATO to that, and then submit your own tax, or you take all this information across to your accountant and they do it all for you. Whichever way you want to do it, it's your tax. First section we're going to cover through is car depreciation. How good's that artwork? Drew it myself. I reckon some kindergarten students could do better than this one. So for car depreciation, there's two different methods we'll look at. One is cents per kilometre method. The other one is the logbook method. So first and foremost, cents per kilometre method. So from 2023 across to 2024, so this financial year that's just occurred, you can claim up to 85 cents to a maximum of 5,000 business kilometres on your vehicle. This works out to $4,250 as a deduction for your vehicle running, and that includes all your insurance, your services, wear and tear on the vehicle, depreciation on the vehicle. It is all of it just kind of put together there. So that $4,250 for a maximum of 5,000 kilometers, that includes your depreciation on the car, all the fuel you use to do that. That includes your insurances, your services, maintenance on the vehicle, everything that's related to your car. $4,250, that's the maximum you can claim. So this is the quickest method. That is method one. A lot of accountants who are doing lazy books, they'll suggest, okay, yeah, cool, how many kilometers did you do? We'll just do 5,000, sounds good, okay, car done. But some of you out there might think, well, hang on a second, I spent more than $4,000 just on fuel itself. Surely there has to be a better way. So for those who've done more than 5,000 kilometers and think $4,250 doesn't quite cut the mustard here, well, the second method we'd use instead of that is the logbook method. So the logbook method, guys, very simple. It is 3 months you need to keep records for of your business use, your private use with the kilometers, so you can work out a percentage of business use over your vehicle. Once again, guys, I've got videos down below in the description to really unpack this and go through it in a lot more detail, but we'll just keep it very high level for now. So that 3 months of logbook history you can reuse for up to 5 years, and that's just to work out the business percentage of your car. So your private use KMs plus your business use KMs equals your total kilometers. Then you divide your business use KMs by the total KMs and times it by 100. That gives you your percent business use. Now, once you've worked out your business percent usage, you apply that across everything: your depreciation on the vehicle, your fuel, your services, your insurance, any mechanical costs, any wear and tear related things, anything specifically related to the vehicle and operating the vehicle. Where this comes in handy is if you have a car that's under 8 years old, so it's a new vehicle in its first 8 years, you can be depreciating the effective life of the vehicle against your business use. So say you have a brand new car, say it's a Toyota Corolla, you bought it for $30,000, and across 8 years of depreciation, that works out to $3,750 per year depreciating. Now say your business use on the vehicle is 80%, that means you'd be claiming a $3,000 deduction for the depreciation of your car each year. So when we're looking at cents per kilometre method on depreciation on car, that's $4,250 if you've done over 5,000 kilometres. Now guys, if you've done 10,000, 20, 30,000, 40,000 kilometres in a year, you still get $4,250. Now with the logbook method on depreciating the car, maybe that's $3,000 straight up there just for the vehicle, and that hasn't included any business use on the fuel, on the insurance, on the maintenance, the servicing, anything like that. So it could work out to be a lot more. So you've got to understand that a little bit. Now, if your car is secondhand, more than 8 years old, well, you can't depreciate the car because it's already reached its effective life, which ties us into our second card here, car costs. Now, to the untrained eye, this could be anything, but to the trained eye, that is a wrench spannery-do, and there is a Bowser for fuel, okay? So trained eyes, they figure that out. So car costs, if you are doing the cents per kilometre method, this does not apply to you, because everything's being packaged in that cents per kilometre, that 85 cents per kilometre, that's covered all this stuff here. But if you're using the logbook method, that's where this would apply. So we've worked out the depreciation on the car with the logbook method. Now we move across to the costs that we apply our business percent usage to. So here you would add up all the fuel that you paid for the year, you would add up all your insurances that you've paid for the year, you would add in your car registration that you paid for the year, you would add in any services or mechanical fixes, any tyres that you've done across the year, anything operating costs to your vehicle, and then you would apply that business percent usage to all of it, and that's your deduction. So guys, you're staying with me? We've done our deduction on our vehicle, and now we've done the deductions across on the cost of operating the vehicle. So that's all covered now. The final bit we move across into is business costs. And this fine artwork leads us in today's sponsor, Masterworks. Kidding, no, I don't have any sponsors on my videos. But you know, how seamless would that have been for like a sponsored content thing? You know, Masterworks, and look at my cool art. Anyway, business costs, let's move back on focus. So the rest of your business costs, these are things not related to your vehicle at all. So these are things like your mobile phone plans, any entertainment that you use when you're driving the vehicle. You know, say if you've got Spotify, what percent of Spotify do you listen to when you're out there delivery driving? Because that could be tax deductible. That's car charges, phone holders, your delivery bags that you pay for, anything that supports you as a delivery driver, they're your business costs. So for each item that you have, you apply across what percent business usage you believe it is, and then that becomes your deductible. Of course, all these things, guys, you need receipts for them. You can't be like, yeah, I paid cash to get this. No, you need receipts or a digital record, which could be your bank statement showing exactly what it is and exactly how much it cost. So you need a record. You can't be like, I paid cash for this but don't have any proof. Okay, that's not how tax works, guys. So you add up all your business costs, you apply your business usage for each item. That's not the 80% or 90% that you use for the car for everything. If you're doing a logbook method, that's for, you know, each item that you do. So maybe you're like, okay, my mobile phone and mobile phone plan is 25% business usage and the other 75% is private. So you would apply 25% to the cost there, and that becomes a tax deduction. 25% of the cost, tax deductible on the mobile phone, just as an example. You know what? Let's just do a full example. We'll run through this one. Okay, so Rupinder has a Toyota Corolla he bought for $30,000 new last year and is in his second year of depreciation. So we'll be using the logbook method. From his logbook, he worked out his business use is 80%. His $30,000 car depreciates using the prime cost method, so it's at $3,750 per year, but his business use is 80%, so his deduction is $3,000 per year on his car. Now, moving that 80%, because he's using the logbook method, across to his car's operating costs, he spent $4,000 on fuel, $1,500 on insurance, $800 on car registration, $600 on tyres, and $700 on 2 services. So when you apply the 80% across to all them figures there, all them numbers, it works out to a further $5,600 in deductions. So Rupinder, he's now up to $8,600 in deductions. Finally, he adds up his business costs. He works out his $80 per month phone plan with the device is 25% business use, which is $240 per year. He spent $100 on food delivery bags, which was 100% business use, and he spends an additional $100 on a car charger and phone holder for his car, which is also 100% business use. Adding this up, his total deductions are now $9,040. So Rupinder earns $20,000 less than $9,040, which means Rupinder has declarable earnings of $10,960. Now, comparing the logbook method across to the cents per kilometre method, if Rupinder just did the cents per kilometre method and added in his additional business costs, Rupinder worked out he did 13,000 kilometres business use, but he can only claim 5,000 kilometres at 85 cents, which was $4,250 plus his $440 in his other business costs, which is his bags and his phone plan, which we covered before. So if Rupinder did the cents per kilometre method instead, he would declare a taxable earnings of $15,310, over $6,000 more in taxable earnings declared than if he did the logbook method. So he'll be paying more tax. This is why it's important to work out which am I in the best situation for. Is it the cents per kilometer method or is it the logbook method? So the cents per kilometer method, that might work best for you because you're like, okay, I've got a 20-year-old beta car. It's completely worn out and there's no effective life left on this thing. I only go out delivery driving, once in a blue moon. So yeah, I'll just claim the business kilometers I did on that. Whereas in Rupinder's situation here, using the logbook method worked out a lot better. So guys, hopefully you followed along there. What we do is we add up our car depreciation, put that into a little column with your business use percentage or cents per kilometer, whichever way you want to go with it. And then if you're not using cents per kilometer, you add up your car costs, apply your business usage across to it from the logbook method. And then finally, you add on your business costs, so anything else that helps support the business, and apply the business use percentages for each individual line item to it. And then you add all that up and then subtract it from your total revenue that you earned from the gig delivery companies, and then that becomes your taxable earnings declaration. If you want to go a little bit lower level into these details, down below in the description, I've got several videos about tax where we break down depreciation even further. We break down how to do a logbook with the logbook method, and also we talk about just things you can claim and declare as well as a delivery driver. So guys, it is tax season coming up in Australia, so if you put all this stuff together here and then give it to your accountant, the more stuff you give to an accountant, the more stuff he has to deduct for you. The worst thing he goes through or she goes through as the accountant is goes, oh, that there, we can't deduct that. But these other 20 things, yeah, we can deduct that. So the more you give them, the better. Otherwise, if you jump onto MyGov, link up the ATO service to your MyGov account, you can link up your ABN to your PayG payments that are already happening there in the background, and then you can just fill out like all your costs, this stuff here for your ABN, and then you got your PayG if you got like a standard job or normal job there in the background. It kind of links in together, and you just get it all sorted out that way, doing it yourself. But guys, it's your call how you want to approach your finances. So go to an accountant, do it yourself. I don't really care, it's up to you. But hopefully guys, that helped out, gave you a little bit of structure how to tackle getting all the information together for tax, okay? The more information you have together, the more deductions you can potentially do. So other than that guys, hopefully it helped. More videos linked down below in the description, okay? If you want more information on this stuff, click on the videos, spend 30 minutes watching it all, and you'll be in better standing doing tax. If you go into tax without knowing anything and you're like, I don't know, you know what? Your accountant's probably just gonna do a cents per kilometer method on you, and you're gonna miss out potentially on thousands of dollars of deductions. So just be smart with it, okay guys? The accountant can only deduct what they're given. They can't make stuff up and pull it out of thin air for you or anything like that. You got to hand stuff over to them. Same as when you're doing your own tax, you got to be able to justify what you're declaring as a deduction. But other than that, guys, take it easy. If you enjoyed this, thumbs up on the video. Subscribe if you like this kind of content, and I'll see you in the next one. Who are your legends? Peace out. Have a good one. Sure.